Hello, everyone. Welcome to another edition of Other People's Money. I am very excited to be joined today by Dan Rasmussen, the founder of Verdad Capital. Dan, thank you so much for being here today.
My pleasure, Max. Thanks for bringing me on.
All right, I just want to do a quick disclaimer at the top that nothing we say here is investment advice. Nothing we say here is marketing or advertising for Verdad or any of their strategies or products. And everything we're doing here today is for educational information purposes. So, with that out of the way, Dan, you are a big milestone for us. You are our first billion-dollar firm that we are going to have on Other People's Money. So, thank you so much for coming on. You're also probably one of the more credentialed fund managers we've had on from Stanford Business School and your time at Bain and Bridgewater. I saw that you were at Stanford in 2013 to 15 when you founded Verdad. With the private equity background and the way that VC was, I got to ask you, what the heck were you thinking starting a hedge fund and not a venture capital firm?
This I've always had this contrarian streak. It's sort of funny. I was in exactly the right place to. I should have just built a SaaS software investment fund or a venture firm, or maybe even better, bought Bitcoin in 2013 or 14. I was attracted sadly to small cap value investing, which if you look at the returns of small cap relative to Bitcoin or value relative to SaaS software, you'll see that it was far from the right choice. So this just shows you that being a credentialed member of the elite and working at all these great places doesn't necessarily lead you in exactly the right direction. One can still make a macro mistakes, but I think uh, rather than thinking about it as a mistake, I think it's more a matter of, as in all of investing, of finding the strategies or the approaches that suit you, that match to your personality and skills and interests. I'm very driven by deep research. I studied history as an undergrad and was really into early 19th century and 18th century American history. I still am. Um, and I've always thought that to understand markets, you want to understand, as much of the past as you possibly could. And, Bridgewater has that approach, and that it really resonated with me of saying, hey, let's learn from history. Let's study the broad patterns of what worked and hasn't worked. And that's what led me into thinking about the strategies I've ended up focusing on, which are all driven by this very long run research. The challenge, of course, to relying on a study of the past and working on things that have been long-term winners is that those strategies are often, in some sense, betting against innovation or novelty. And the recent few years have really been the triumph of innovation and novelty in a variety of ways. We've seen massive developments in mobile and the cloud, and then moving into semiconductors and AI. And so, I think that one could accuse those of us who are more informed by history of betting against innovation. I think that's to some extent true.
What was the research that you were doing? You were obviously in school at the time. Was it part of the studies you were doing there, or was it an external project that sort of led you to this? And then I want to get into like the chicken and egg question of research. Like, how do strategies come from the research first, or do you have an idea for a strategy that leads you down a research rabbit hole?
Yeah, yeah. So I interned at Bridgewater in college, and that sort of got me in the mindset of thinking about investing from a principled way of saying, what are the long term evidence for a given strategy? What are the cause and effect relationships? How do you discern sort of the rules that govern markets? And then I got into private equity at Bain Capital. And private equity is very single asset oriented, right? It's very deal oriented. A company comes across and you analyze it almost sui generis from any other company you've ever looked at. Obviously there are people that have an industry expertise, so they've looked at similar companies before, but each company is sort of taken on as its own question. And I got really interested in saying, well, how do I sort of reconcile these two very divergent things? And to be honest, private equity has done so much better than a lot of these hedge fund strategies. I was also interested in, what can we learn from private equity? What have they been doing right, and how can we put that in a context that makes sense from an evidence perspective? And where I got to is sort of looking at the quantitative characteristics of private equity and attributing the outperformance to those quantitative factors. And the main quantitative factors that to determine or that define private equity are really size. Private equity is investing in very small companies, generally in the micro cap range of public equity. Two, private equity firms are buying with debt. So generally about 60% net debt to enterprise value, or public markets are 10-15% levered. And then third, and this is sort of the genesis of my firm, historically, private equity had bought at about a 40% discount to public markets. So there was a time in the 80s and 90s and early 2000s where you could go and buy small private companies and then sell them to public companies that traded a huge premium to the private markets. So there was this arbitrage gap, which makes sense in some sense, right? Like it fits with our worldview, right? If you own a deli down the street from your house, should that deli trade at the same valuation as Subway, a lower valuation as Subway, or some big publicly traded deli company, right? You'd say, of course, it should trade at a lower valuation. It's a one-off. It's a tiny business, whereas they've already accumulated scale, and that was true.
And the
But
illiquidity discount.
Yes, an illiquidity discount, which should lead to an illiquidity premium. Um, but by the time I was investing in private equity, and this was still, relatively in retrospect, the early days of the private equity mega boom, valuations had really closed so that you were generally paying pretty comparable prices in public and private markets. But the private companies were much smaller and generally, lower return on assets, lower margin than their public peers. And so it didn't make total sense to me. And I said, well, gee, if historically the return drivers have been buying small, cheap companies with leverage, now we're buying small, sort of moderately priced or expensive companies with leverage. Is the private equity still going to work? And could we find instead an analogous way to approach this in public markets to say, let's go buy small, cheap companies with debt in the public markets? And it turns out there are a ton of public companies that have debt on the balance sheet that are small, that are cheap, and can you construct these types of portfolios and sort of mimic the returns of private equity? But really, not I didn't really want to mimic the returns. I wanted to mimic the historical success of private equity to try to capture the lightning in the bottle that was private equity in the 80s and 90s and 2000s. And that was really the genesis of the firm, was trying to reconcile these competing ideas and to figure out a sort of quantitative, systematic approach to capturing the alpha that had been generated by PE.
Obviously, they're pulling a little bit of an operating lever too. In on your side in the public markets, is there any bit of activism of finding companies that say, hey, maybe you could add a little bit more debt, you could lever it up a bit, or are you only looking at the companies that have already taken that debt on?
Yeah, I'm a skeptic of the idea of operational improvements. And for a whole variety of reasons. One is that, if you're running a company, presumably your goal in running the company is to maximize its success. And so, a new owner who also wants to maximize its success, they have the same, maybe they're going to pull different levers or think about different strategic things, but it's not immediately apparent that you're going from a world, especially if you're thinking of private equity is now 40% private equity firm to private equity firm. So, if you're Blackstone and you buy a company from KKR, where's the operational improvement that's coming, right? Shouldn't KKR have been running it pretty well, and now you're going to run it pretty well? And maybe people run companies pretty well generally in America. And so, what is sort of the magic secret sauce, right? And if you also think about it, where does private equity hire from? Generally they hire investment bankers. And there's no point like, think of your first 2 or 3 years as an investment banker. What do? You build models, you build slides. It's not immediately apparent that that should be a skill set that should also lead you to magically be able to operate companies better. If it were, it'd be sort of miraculous. But I don't think so, right? And so you'd think, well, what operational change do people with good modeling and PowerPoint skills tend to do? Well, they tend to be very good at M&A. And so they tend to be very effective at using leverage, changing the balance sheet, and they're often quite effective at doing roll up strategies and divestitures and things like that. And so I think also all those capital markets type things seem to me to be the true expertise of private equity, not say magically improving margins or magically improving revenue growth. Which are just really hard things to do anyway, right? And if there was sort of a magic methodology where every private equity firm knows how to improve companies, and everyone not in private equity doesn't know how to improve companies. Maybe business school would start teaching like the private equity approach to operating companies, and we'd all go and learn these secret, magic things. But it sort of boggles the mind that both Blackstone and KKR and whatever could all have this magical thing, but no one else would know about it. It just doesn't make a lot of sense.
Okay, so the thesis clearly got some traction, and this was the first strategy, the genesis of Verdad. When you launched the fund, who were the types of investors that you had in mind with this? I mean, there's always a product market fit. Were you thinking about allocators that traditionally were looking at private equity, or are you thinking about people that traditionally allocated to public markets? And how did it break down in those early years? Obviously what you think is going to happen and what actually happens often differ quite a bit.
Yeah, so I started my business with very limited capital. I was in business school, and essentially the people that I could convince to invest with me were a bunch of people I'd worked for, and then random people in my network or extended network who believed in me. A friend from church, a former boss, and that was sort of how I cobbled together. I think it was $8 million to launch my firm. And I think there's when it comes to fundraising or product market fit, I'm sort of more, I read sort of the all the SaaS software type books when I was at Stanford. So maybe I think I probably run my business more in line with a lot of these software approach than I've managed money, which is much more in line with a rigorous quantitative methodology. But I think a lot of what I learned in business school, which is from reading about software companies, right, is you just have to experiment, right? You don't really know, and I think there's an overthinking that can be done. Who's my target? Who's my target allocator? It's like I don't know. My target allocator is like whoever likes my strategy and wants me to write me a check, right? Like I don't know who those people are, and I think in investing, and especially sort of the credentialed world I came from, there's a lot of thinking about strategy and thinking about targeting and that sort of stuff. And I think my approach in terms of raising money was, generally 99 out of 100 people are going to say no to anything for a whole variety of reasons. It's not the right time. It's not the right fit. Whatever. And so your challenge, rather than thinking, how do I go from 2 out of 100 saying yes, or 1 out of 100 saying yes, or picking the right 100, why don't I just think of how can I reach 1,000 people and multiply my prospects by 10? And that's been more my focus of saying let's try to reach a very broad range of people in the hopes that you find that needle in the haystack of a person who wants the exact strategy it is that you're doing, or for whom the approach resonates. Rather than putting a lot of thought at the outset into who that person might be, because who knows, after all, it's very hard to tell. And even if you could tell, the sort of success or match ratio in raising money is very low.
Yeah, and I mean, it's such a huge debate that people who are founding investment firms always have. Is it, do I take on a big seed and I'm giving up some amount of the GP, or maybe you're lucky enough to get an anchor who you're giving some concessions on management fees or performance fees, but they're not coming after your your GP stake. Um, versus building it, letting it grow, having the track record, starting out with friends and family capital essentially, and letting the product speak for itself over time. Um, Clearly people do it both ways. Um, but what was the point where you started to get that traction? How long did you have to start to build a track record? And obviously, there's the problem of people who are able to write larger checks don't want to be too big a percentage of your fund. So you do kind of have to grow and build with smaller checks first before you can even take, you know, a couple $1 million from somebody,
Yeah,
$5-10 million check, which in the grand scheme of things, it's big, but it's also small.
yeah.
It's
I
not
think
enough to sustain a business.
Yeah, I think there's two sort of notes of caution, or things that I've learned that I warn people against often. I think the first is, there are some people that are lucky enough to launch with a big check, right? Someone says, "I'll write you $100 million check or a $200 million check," and the person thinks, well, great, look, I've got this huge anchor or seed or whatever, right? And often what it doesn't occur to them is, if someone has $100 million to write a check, they probably are taking that 100 million wasn't didn't just emerge out of the ether. It was with somebody else, and they're going to take it from that person and give it to you. And so at some point they'll take it away from you and give it to someone else, right? The money isn't permanent, it's transitory, and as quickly as it came is as quickly as it can go. Whereas building up longer term relationships, maybe even if they start smaller, I think uh, you're able to build a more sustainable business, that's not as dependent or as risky, and is more oriented around longer term capital than some of these, big in, big out, fund flows. I think the second point I'd make is that, these days, and again, this is maybe the Stanford SaaS software approach. The old method of massive capital investment and team investment prior to fund launch, I don't believe is necessary anymore. You can outsource compliance, you can outsource mid and back office. If you work with interactive brokers, rather than a prime broker, you can save yourself the cost of a trader, you can save yourself the cost of a CFO, and you can save yourself the cost of OMS software, all of which can collectively add up to a few $100,000. And then if you want to think about data and the sort of tools you're going to use, well, gee, S&P Global competes with FactSet, competes with Bloomberg, and the entry level pricing on that stuff is quite low. And you can scale up over time. And so, to my view, the sort of barriers to entry and sort of the fixed costs associated with a hedge fund business or investment management business are much lower. And so I've always thought, let's be prudent, in the same sense we're prudent with our investors' money. Let's be prudent around our management fee. What are we spending it on? Let's spend it on the things that matter to our investors. Well, what do they care about, right? They care about making sure we have the best people, that we have the best research, and that ultimately we're generating the best returns, hopefully, given our strategy. And I don't think any of that is really served by spending a massive amount on sort of bureaucracy and this sort of do they really care about what order management software you have as long as they're making money and that everything is working well? No, right? Like you should be very thrifty and cost effective on those things, and I think that makes a lot more sense. And so, I tend to be much more oriented, and that's partially just where I came from, right? I started with a very small pool of money and a very small revenue base, and I wanted to do everything in an economic way and make sure that the maximum amount of dollars were oriented towards things that actually matter to our investors, rather than just things people told us we had to have because we were a hedge fund. Oh, you've got to have a CFO. Well, why? I still don't have a CFO. Why do I need one? I don't know. Why can't I outsource that and do it more cheaply and effectively?
And obviously it's been 10 years since you launched, and the industry has moved a lot more towards this outsourcing model. Was it that way in 2014? Were you able to be as thrifty, or have you actually been able to be more thrifty as things have been commoditized?
I would say that the sort of outsourced back office compliance, mid office function that had already existed in 2014. Certainly when I launched, I think it's grown in popularity and in institutional acceptance, and I think it sort of should have, right? I mean, I think um, you think about compliance, right? My compliance team at IQEQ works with 50 other funds. They go through a ton of SEC examinations. They know what best practices are. They know what the pitfalls are, right? Would you rather I work with that team or with some random person I hire from some other fund who has an N of one experience, right? I mean, it just seems like it's a better outcome, to have you're just adopting best practices for all of these things sort of automatically by engaging a sort of outsourced provider, and that makes a lot of intuitive sense. Probably I'd say where the bigger developments have been on the data side, where this sort of evolution of SaaS and subscription software and things like Snowflake. You've just seen a massive reduction in the cost of data. And for a quantitative fund like us, that's really important, right? Like we don't have to have in-house servers. We don't have to clean the data ourselves, right? Like it's all being done in real time in the cloud. And by the way, the products are constantly improving, and you have multiple providers for almost everything. And so you've got a great degree of choice. And so I think, you think about the cost of operating a business like ours. That's been the biggest change since I've been in business, has been how sharply the costs relative to the quality of the data that you can purchase have become.
Well, if somebody were to go to Verdad's website today, they would see a pretty large built out team. Not that you haven't done so in a thrifty manner, but this idea of, super thrifty, small, lean team maybe doesn't fit with how the firm is today. So clearly, you did start to invest a little bit more into human capital over time and bring people on and launch new strategies. You have a great internship program that I've noticed and seen people from that go on and to do great things. So when did you start increasing headcount? What was the sort of AUM level where you said, okay, I can really start to invest in talent, invest in research to broaden what Verdad is?
Yeah. So from the beginning, I've been oriented around that, right? It's not thrift for the sake of thrift. It's thrift to have the money to spend on the things that matter. And people are what matters in this business, right? You've just got to have great people, because those people are going to drive your research and they're going to be managing your strategies day to day, and they're going to be building out the infrastructure. And so that's been very important to me from the beginning, making sure I can attract great people, make them happy here, make them enjoy work, and have the resources they need to execute on the work that we're doing collectively. And part of that has been an internship program, which I've had from year one, where we bring in college students from Harvard and Yale and Stanford mainly. We teach them a class, so we're contributing to their human capital. We have them, do some research and work on both like an individual stock pitch and a research project, and then we help place them at other firms, and we have a great track record of doing that. And that was part of my long-term plan of thinking, gee, when I started, maybe it was a one-person firm. Gee, if I'm going to grow, I'm going to need a lot more great people. And I don't know when I'm going to need to hire them or what they're going to need to do, but I'd rather have a network of people that and who knew me, had worked with me, who got a sense of what my firm was, that I can call and say, hey, do you know anybody who's an expert in this? Or do you have any friends who are looking for a job that meet this criteria? So I'm very, very, very focused from a very early period on developing that HR network, and of look, 99% of the interns we've had have not come back. We've had three, I think now three interns who've come, four maybe, sorry, four who have come and worked for us full time for a period as analysts. And so that's been wonderful, right? But the vast majority of the interns we've had have gone on to work at other places, and they're thriving. They're at Bridgewater, they're at Farallon, they're at Bain and Company. They're doing great, and I'm really proud of that. And it's fun. Whenever we travel, we often meet up with our former interns who are usually doing really well, and they had a great experience and got introduced to the industry. And I think that sort of approach, to me, I hope reaps long-term benefits, even if in the early days, it felt like more like we were giving more than we were receiving. I think that, in business, that's the nature of a lot of things. You have to give more than you receive for a long period of time, if you want to build something really big and sustainable.
Now, I imagine interns from Yale, Harvard, Stanford have other opportunities too. So I'm assuming you've had to pay them as well from the
Yes,
outset.
yes. I think paying interns is both complying with the law and a good practice. But I think even more than money, most of them want training. That's much more important, right? And so we teach them a course, we give them real training. By
Quite
the time they
extensive.
finish our internship, they're very well qualified to work in the industry, and have a very clear sense and perspective, and that's very, very important.
So, do the interns, I mean, you put out so much research. In preparing to speak with you today, I tried to go through and just manually count the research pieces, and I made it from like 2016 to 2020 before I was like, okay, we're over 200 pieces here. It looked like the publishing consistency and frequency, because you call it your weekly research. And I think in 2016 it hit maybe over 30, so not quite weekly, but still over biweekly. And it just kept on increasing. So is that coming from the senior staff? Is that coming from the interns? How is the research being produced to put out so much research?
Yeah, so I think first of all, we're a research-oriented firm. That's what we do, right? That's our day-to-day job. What am I doing? What are my team members doing? They're doing research. I can go through and tell you exactly what research they're doing. Lionel today is working on biotech and what factors predict returns in biotech, and how does that compare to just owning the biotech ETF, and does it work on the long side and the short side, right? Now, will we write a research piece about that? Maybe, maybe not, but we'll have done it. Might as well write a research piece on it when it's done, to the extent that we like where the research comes out. Now, of course, everyone that does research knows that for every five research projects, three are dead ends, right? You go into it and you say, hey, we're going to really try to figure out how agricultural futures work. And, you come out 3 months later and you said, I don't know anything more about agricultural futures now than I did 3 months ago, other than they don't make a lot of sense to me. So there's a lot of gravestones of things you thought would matter that didn't, or you thought would lead somewhere that didn't. But generally, all we're doing day in day out is research, and then trying to apply. It's applied research, right? We're trying to make money in markets. So we're studying things that relate to that, obviously. But a lot of our research then comes out of that. Now, the next layer of our research is that we have a lot of investors, and our investors call us and say, "Hey, we're wrestling with this problem." A very recent one that's come up all the time is people say, gee, I can't figure out, should I take it up to 80% US, right? The US just seems to always do better. Why am I doing international investing? Should I just give up on it? We'll say, well, just let us look into that. Let us put some numbers around it. Let us contextualize that for you. And if we do that for one of our investors, why not share it with the rest? And then I think the third is sort of just free form things that come to mind that we're interested in and want to know and think about. But those are the sources of ideas, the things that we're directly working on that relate to how we invest. There are things that our investors want to know that they need help thinking through. And then there are things that just come to mind, or that are issues for us that we've been thinking about, talking about internally, that we want to write about, even if they're not explicitly related to one of those two things, because they might tangentially lead to something like that in the future. And in terms of who does it, for a few years, it was 90% to me, and I love writing and editing, and so that's great. And more now, everybody sort of contributes. So it's generally everybody has in the back of their mind that once a month or so they're going to have to write something, or once every 2 months, and so people are just cognizant that whatever they're working on, if they see an avenue for that project to turn into a research piece, they'll do it. Or if they see an interesting article they want to write about, they'll do it. And then I edit everything. So everything that goes out, I edit and rewrite to some extent or another. Sometimes it'll be nothing, sometimes it'll be major. Our interns will contribute over the summer. And then I hire a firm called N2 Communications, which is run by a friend of mine from college, Joe Flood. And they copy edit and edit everything we write too. So my view is, even if you're a great writer, you need a good editor. To improve, to make sure the quality is good, make sure you're not making mistakes. And so they edit everything we do as well. So it's a whole sort of machine, again, outsourced, but we write it, I edit it, N2 edits it, and then it goes out. Compliance approves it, of course, and then it goes out. But I think we've really thought about having that publication process be efficient, and also make sure that we had multiple eyes on everything that goes out.
Well, obviously, it drives the strategies, and it drives the growth of the business in that way. It seems like it helps with maintaining relationships with existing investors, but as a marketer as well, like there is a brand building aspect to this. Like, how are you? It's such a highly regulated industry. It's so hard to talk about what you do, and to go out there and to make a name for yourself. I mean, you're not alone in this. Like AQR produces a ton of research. GMO, Jeremy Grantham, famous for their research that has everybody gets in their inbox. Can you talk a little bit about how research has helped you to meet new people and develop relationships? It's not like you put out a piece of research and somebody calls you up and writes you a check, but can start a conversation, and it starts a way for people to then they start reading your research and they understand how you think about the world and how you think about investing. And I'm sure research has been a lead generator for you in terms of eventually turning into capital.
Yeah, I think that people want authenticity these days. I think no matter what sphere of life, whether it's politics or entertainment or fund management, people want an authentic. They want to know who the person is, and they want it to be honest and to feel like that they have that personal connection or understanding of an approach. And so, my view is that, how do I raise money? It's like I'm not a guy that's really good at going out and pressing the flesh or, hanging out at the golf course or, whatever it is. However, people have an idea of fundraising. That's just not me. I'm not good at that. I feel uncomfortable. Like, what am I going to say? Like, hey, do you want to invest some money next Tuesday? It just feels kind of gross. It's just not me. But I run a money management business, right? So I got to grow my business. So how do I do it? And I think my view has always been, let me just tell you honestly what I'm doing, what I'm interested in, who I am. And for those people that are attracted to that, great, right? That's a great fit, right? They've found me because they like what I do and the way I think, and it resonates with them. And that's a better relationship because it's based on something authentic and it's based on a really deep understanding of a set of opinions and values and approaches. And I think it's more long lasting because of that. I feel like I know a lot of my investors really well. I correspond with them. We talk about ideas. They send me research ideas, that sort of thing. And I think that's motivated by something that's personal to me, which is that I love doing research and writing about it. And I believe very strongly in using long term evidence from history to answer important questions. And so I think that that's how I've grown my business. But I think there are other people that are great single stock pickers, right? Well, if you're a great single stock picker, well, write about the stocks that you're investing in, right? Like tell people about it. And if they like the reason you chose that stock, that they'll probably like the way you choose other stocks. Like everyone needs to find that, I think, in this world, find the things that are authentic and true to them that differentiate them from other people and communicate them as best they can to as large a number of people as they can who are relevant. And to me, that's sort of what is the best way to grow a business. Whether it's a car business, right? Like, well, if you love building fast cars, well, like do a bunch of road tests and car races to show how fast your cars go, right? Like, that seems like a good, authentic way to communicate to people that care about how fast cars go, right? Just find what it is that um, uh, uh, is your sort of niche or the thing that people care about. I think it's not till you're really big where you can just have a brand and people just say, "Oh, well, they're good because they've been around a while." And it's like Capital Group. Well, Capital Group's an amazing firm. They have an amazing reputation. Do they need to produce a ton of research? Do they need to have an authentic connection of the portfolio manager to the investor? Not really, because they've built such a great reputation as a firm that people generally trust that the products they put out are going to be roughly in line with what they expect. But as someone new in the industry, defining yourself and having people find a way to understand and get to know you, I think is really important. And research is a great way to do that. But writing in any variety is a good way to do that because it communicates at scale.
Yeah, and obviously you talked about compliance gets their stamp on it. I think there are a lot of people who get a lot of advice that saying anything in public. You go to most hedge fund websites, it's got a picture of a tree or a rock or the New York City skyline, and it says info at xyzcapital.com. And there's really nothing more about them. You don't even know who works there. Um, and some of that is a branding decision in their own, that this is a secret and it's only for those in the know. Like, that is a branding choice, but a lot of times there's also a compliance aspect to that decision, that it's a headache to put out research and to make sure that you're on the right side of regulation. So, how do you think about what is acceptable to write about and what isn't acceptable to write about? And then as well, how you make sure that you're not on the trading side doing anything that can be a problem based off of what you've written.
Yeah, so I think maybe the sort of broader topic of sharing and being open, right? I mean, I think there's multiple reasons that people give for not being open and sort of sharing what they're thinking. I think the first, actually, if you talk to a lot of people, they say, "I don't want anyone to steal my ideas," and I've always thought that was a little crazy, right? I mean, if you're like a guy with a $50 million hedge fund, who's going to steal your ideas, right? Like nobody is listening to you anyway, right? Like, at this point, right? Like, you just want to get your voice out there for people to hear. And if anyone thinks, "Oh my gosh, that guy's so smart, I want to steal his idea," most likely they're going to say, "Oh my God, that guy's so smart, I want to invest in his strategies." Not, like there's no universe of like if you're where people are going to steal your ideas that aren't instead going to invest with you. And even if the ratio is 1 to 1, you're probably still better off. And gee, I don't even know what investing, what ideas in investing are secret, or like, like some pure trade arbitrage thing that no one knows about. Like, I don't think those things really exist. So,
And if
I
that
think
edge is so erodible, likely it's going to be eroded anyway. Somebody else is going to figure out. There's so many smart
right.
people in this business. Like, okay, so it's a year faster by sharing, but you didn't get any AUM in the door.
There are a lot of smart people. Like, your ideas are like someone's probably thought of something related to your idea before, right? I mean, like, I don't know. I invest in like large, high quality businesses with great moats, right? Like, you and 100 other people, right? Like, what's the issue with you sharing that that's what you do, or that you really think that Exxon is a great moat or something, right? Like, who's going to steal that? So I think the first thing is just sort of, I think maybe a little bit of humility, right? Like, we're all students of the market. You don't have some special secret sauce. I don't have some special secret sauce. We're all trying to figure this out together, to try to figure out what the best strategies are, the best approaches to manage money. No one's out there to steal your stuff. People are out there to learn from each other in a collaborative way. But I think that that's a much more healthy attitude toward the world than imagining with suspicion that people are trying to steal your ideas, or that your ideas are stealable, etc. So I think that's the first. The second is compliance concerns. And I think part of that is thinking, why do these compliance laws exist? Well, they exist for very good reason, right? Like, they're trying to tell you not to do things that are bad. Well, what is bad, right? Well, pumping and dumping a stock is clearly bad, right? Boasting about your performance to attract capital, cherry picking I had this stock that went up 200% last year, so invest in me when all your other stocks went down, and in aggregate you were flat, right? Like, these sort of deceptive things or pump and dump things. That's the reason this compliance stuff exists, right? Compliance exists, the legal and regulatory frameworks exist to protect investors and to prevent you from doing something that's inherently problematic or fraudulent. But if your intent is to say, I want to write about stocks that I love, no regulator is going to get upset about that, right? Unless you're saying, well, the stock I love is a $20 million market cap, and the minute I don't love it is the time it went doubled because I convinced some guy in the Bronx to buy it, right? Like, I mean, there's obviously gray areas, but if you're saying I want to write about why I think Intel's a great buy, you know, there's no compliance problem with that, right? What are the regulators worried about? And I think generally, writing about philosophy and studying the markets and how things work, and even single stocks, I just don't think it's what anyone at the SEC or whatever is all that worried about, because it's not pernicious, and in fact it's helpful. It helps people understand what you're doing. It contributes to the broader discourse. It adds to transparency, all of which I think is a positive, not a negative.
And you said you think this is what the I mean, you're at 10 years. I'm sure you've gone through a review as all RAAs do. You can't the SEC is going to come in and do a review of your firm if you are an RAA for long enough. So this is speaking somewhat from experience, not just speculation. They've come in and they've looked at your research and all of that. And obviously they have the new marketing rule that they've put out. And a big part of that is like substantiation of facts and whatnot. So when you're producing research, I mean, is that a big part of it?
Oh
Keeping
yeah,
records of
I'd say
how
well,
the
I'd say
research was
that's
created?
I'd say that's part of my philosophy anyway, right? Like, I think that you should invest based on facts, and you want to cite your facts. So, to me, like, I don't know, that seems pretty basic. But yeah, I'd say the most common sort of compliance changes that we sort of go through is like, is every fact attributed? Okay, good. Like, there's a link to everything. Okay, great. Like, then you feel good, and then you just kind of tone down the really strong language, which always a little bit annoys me because you know. Um, if I say, um, it's time to buy X type of stock, versus I say, in my opinion, it might be a good time to buy, right? Like, I don't know that they're all that different, but I get why, from a compliance perspective, you want to sort of shade it in that way. And so those are the most common things. But you do those two things kind of consistently throughout. Um, you're very much in the black and the white, that you're very much on the white side of things, right? You just be a little bit careful about the way you phrase things. And there are lots of smart compliance people like IQEQ, who we work with, or N2 Communications, who does our editing, who know what these rules are and can help you edit them. And I say it's certainly valuable. You certainly want to have someone doing that review, right? That's sort of essential in my mind. Um, but as long as you're being careful and you're having someone review it with those things in mind, I don't think there's any issue with publishing research. Again, AQR does it, GMO does it, Bridgewater does it. There's a reason all these big companies are writing research, and they're not getting in trouble. And look at look at Cliff Asness on Twitter. He's interesting, he's fun, right? Like, do you think he's like wandering around being like, oh my God, what is the SEC going to say if I come out and say what my view on the Israel conflict is? No, he's just like, I'm myself. And like, obviously, I can say whatever I want about Israel, and it's not going to be come under some compliance review. I should just be myself. And I think that's a much more reasonable view of the world.
Yeah, I mean, it might affect whether somebody, writes the check at the end of the day. I mean, certain opinions do make it
Yes.
harder to get it through investment committee or whatever. So, but for every person that's like, oh, we have a very down the middle brand, there is somebody else who says, I like the cut of your jib.
Yes.
And that's another thing too, which I think so many people try and like market to everyone versus saying like, this is who I am, this is what we do, and we understand that we're cutting off, X percentage of the capital out there, but our message is going to resonate so much more with this other group. And there is so much capital out there. Like you could market to a small subset of the, investing public and still have a huge pool of capital of potential investors. I mean, what do
Yeah.
you think about that about marketing to your guys?
Yeah, well, I think even I phrase it less as marketing too, because who
Yeah.
the hell knows?
Yeah.
And instead being yourself. Just tell people who you are, and be conscious of how who you are is different than everybody else, right? It's differentiation. And then the people will find you who like that, right? And I don't know who those people are, and you'd probably be surprised at who those people are yourself, right? Like who knows who your true audience is? Who knows who's going to really like you or who's not going to like you? I'm not sure I've ever had all that good judgment of that anyway, but I've tended to like the people that like me, and that sort of worked. And it's just like making friends, right? If you're sort of really guarded all the time, tell it, what are your hobbies? Oh, I can't tell you about my hobbies for compliance reasons. Well, how are you going to make any friends, right? Like, whereas if or like that's the advice on your resume, like what are your interests? If your interests are like Python and Excel and formatting PowerPoints, right? Like, well, nobody's going to read that and think, well, this is a really fun guy. I'd love to run around the office. Whereas, like, if you write like I'm an Olympic level ping pong player, the people that think that Olympic level ping pong, there's like that's actually going to attract some people because they're going to say, well, that's cool. I like ping pong, or I like Olympic athletes, or that's just amazing. Like, that's fun. Let's talk about it. Just being authentic and being open enough that people can get a real sense of whether it's a good fit or a good match, I think is sort of the answer, without giving too much thought to, I think giving too much thought to who my audience is or who am I marketing to is almost certainly decreasing your authenticity, because now you're shaping your message for somebody else rather than for you. Who are you? What do you stand for? I think that's what resonates in today's world, especially in the world of Twitter or online content generation, or even radio or podcasts.
So that begs the question, Dan, who does like you?
My wife, some of the time, my
No, but
mom.
I mean on the investing side, obviously, you start out with friends and family, and your investor type archetype changes, and a successful fund has generally no one archetype of investor, but it changes as you grow, and it changes as you have new strategies. So
Yeah.
does it differ from
Yeah.
strategy to
Yeah.
strategy? Has it
No,
changed
I
over
that that
time?
that's a great I didn't mean to answer it so flippantly. But I think that, for my firm, what defines our investors? Our investors tend to be people that are really interested in thinking about the history of markets, understanding what data says, who trust data, that they say, "Hey, gee, I trust a factor model more than I trust some individual person's judgment," right? And so you have to have some view that, you care about data, you care about history, you care about empirical research. Um, 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 those are the type of people that end up investing with us. I think there are people that are persuaded by data too. I think that's an important thing. They're persuaded by data, right? They can read a piece of data and say, "Oh, that changed my mind about X topic." And that's a subset of people. It's a specific profile, and you can find them anywhere. Sometimes they work at an endowment, sometimes they run a family office. Sometimes they're just some retired guy that ran a business and whatever. But for me, that's the defining attribute, and that's why they read our research and they like our research and they want to know more about it. And then when we have calls for people that want to know about what we do, we just go through a bunch of research and spend time talking about that. And there are people that I think really like that approach and believe in it. But I think there are other approaches out there that have not, would have nothing to do with us, right? I mean, I think there's especially sort of probably the whole sort of Yale endowment model, which is, if you say, what is a Yale endowment cub looking for? Someone who's fundamental, right? They don't like quantitative at all. So you got to be fundamental. They want people that have a single strategy, right? So you think your way is the best way, and it's motivated by your deep expertise and research in a given topic. And probably they like people that don't market because they, which is also sort of a funny thing. But right, and so if you want Yale to invest or a Yale Cub, well, be a person who is really deeply, intensely, fundamentally research oriented around a specific topic with some legitimate expertise in that area, who has shown consistent ability to do that over time, right? That's sort of what they want. Um, uh, a person like me, who is a quantitatively oriented manager that runs several different strategies, and speaks publicly a lot about what I do, just probably doesn't fit the Yale model, right? And that's fine, right? It's not, we don't need to have every investor type love us. But you're aware that there are some people that are going to be attracted to what you do, and others that it's just not the perfect fit.
Yeah. Well, Dan, I'm sorry to put this on you, is because I haven't done a good job of this yet. It's so obviously when you ask people about their business, they talk about what they do well, all of the great decisions they've made. But I haven't done a good enough job in my show thus far of asking people about things that have gone wrong for them, mistakes they've made, things they wish they would have done differently. So maybe what is something, a pitfall that you fell into in building the business, you clearly climbed yourself out of. That maybe you'd like other people to watch out for.
Yeah. So, look, it was funny. I remember like my high school, like college interviews, and someone asked, what's the greatest mistake you've ever made? And this was maybe in 10th, 11th grade, and I said, look, I'd say first of all that every mistake has been a learning opportunity, and so you know, I don't look back and say like there was some irrevocable fork in the road and I went down that path and thus I'm on the road to perdition. The process of doing anything is the process of making a ton of mistakes and doing things wrong. And I think the key to it, in this perspective is, can you do it enough times, right? Can you keep doing it? Like that's why entrepreneurs always talk about persistence. Well, why does persistence matter? Because the first 9 times you do something, you're not going to do it right. And so if you're the person who gives up because you didn't do it right, then you're never going to make it anywhere. And so persistence, I think, is the defining attribute. And so you can just sort of look at anything that I've ever done, right? Like, did I do marketing right? No, screwed it up in a million different ways, but I kept doing it until I got decent at it. What about hiring? Did I do that right away? Well, probably not. Like, did I get lucky a few times? Yeah, but did I make mistakes as well? Sure. But I had the idea of hiring interns. So gee, all of a sudden now I'm hiring 3 or 4 people a year. And gee, even if I make 75% of those are mistakes, at least I've learned a little bit about hiring. So when I have to hire someone who's a full-time employee, I at least have some arrows under my quiver. So I tend to think that it's hard for me to look back and say a mistake that led me on some bad path, which in my mind is the definition of mistake, rather than seeing constant level of failure, error, run into a wall as the constant daily nature of running any business. And the defining trait is, do you persist through it and try again? And do you learn from it so you don't make the same mistake twice? And I think those are sort of the only things that you can hope for.
But I think as well, like with the intern example, the idea that if you make a mistake in hiring an intern, it's over at the end of the summer. Their fingerprints are on a few things, but not on everything. So you're getting to learn about hiring in a sort of lower stakes, lower risk way. When you think about branching out to do something new, I mean, does that come into effect? The idea of like, let's start small, let's keep it low risk, let's manage our drawdown potential here on this decision, whether it's investment decision
Yeah,
or
or,
business
or even
decision.
our research, right? We write publish weekly, right? So like, have we written research pieces that in retrospect were, not all that good? Like, yeah, I can go back and show you a few that I think are kind of wrong, or but the publish we publish so much, right? Like, and the quality of the research we published in the last 12 months is materially better than the stuff we published in 2016, and that's great. But I think that the more frequent you can make these things, the more resilient you'll be in some sense.
Yep. And I want to also ask about the sort of as a final question is the way people paint you based off of what you say. Obviously you took this very strong stance on what drives private equity returns and why you think it's perhaps inferior to doing the same thing with liquidity. Bashing PE is in vogue. You've got Cliff out there talking about volatility laundering and thus far nobody has really blown up in the private equity world. I'm sure there are some LPs who are wondering where their capital is over the last few years, but that's sort of like the biggest issue that we've run into thus far is you're gonna have to wait for your money for a little bit longer. How do you think about you do go out and you say things and people misinterpret it and you become an image of Dan rather than the actual Dan.
Yeah, I mean, I think that when it comes to private equity, um, there was a period where I would have said I'm either early or wrong. uh, Now I think that the metric might have been, in 2020 or 21 or 22, more on the Dan was wrong and private equity's done pretty well, and he was sort of a Pollyanna. And gee, why was he wrong? To now, people I think are sort of saying, hey, wait a second. I think there are louder, smarter voices like Cliff out there, sort of saying a lot of the things that I've been saying for a few years, and a lot of new interesting things as well. Uh, but um, but I think that what you're seeing in terms of this big drop in distributions, you know, uh, uh, if I have a house that's for sale and I can't sell it. There are two ways to interpret that. One is you're going to have to wait a little bit longer to get the money from the sale of that house, or the house is mispriced, right? I mean, so you look, well, what do we believe about private equity? They can't sell the things, so that tells us probably that the valuations that they're holding them at are probably a bit too high. And already trailing returns in private equity relative to public markets have been coming down, and the gap has been closing. But I think there's been no great explosion or blow up, and certainly no dire catastrophe that people could point to that would justify my critique in that sense. But I think time will tell, and I think you know. I think I am right, although I think I also was early. And sometimes being early is wrong in investing, but in this case, given the lockups, I don't think that's the case.
Yeah. But what about dealing with obviously like 2020, 2021? Like now you've got the lack of distributions. You've got this thing that you can point to and say, see, I told you a little bit, but there was a period where I'm sure for every bit of stuff you put out, you were getting it right back in terms of commentary. There's no
Yeah.
shortage of commentary, especially with the Twitter burner verse of people who are all very smart, and many of them work in the industry and are just as or more successful than the people who are not anonymous out there who love to tell us all when we're wrong. You
Yeah,
can't avoid
I think that's just part of it, right? And I mean, I think that part of being in a market, right, is that, everything is pretty close to a 50-50 thing, right? Like if you're buying a stock, it's because someone is selling it. So, you should be used to, every transaction is an agreement born out of a disagreement. And I think that's part of the nature of investing. And you'd be stupid not to listen to the criticisms and think, well, where could I be wrong? And again, the people on Twitter are really smart. So I think I found that one of the advantages of being open about my research is that I get a lot of great feedback. If I say something dumb, I figure out that it was dumb like within 10 minutes. 'Cause I get some email saying, gee, Dan, graph three is wrong for this reason, and I value that, right? Like I'm trying to be a better investor. And I think that feedback is valuable. And I think it's, better to approach it that way than to think that everything is some, great struggle where you have to be right about everything. I'm putting forward my best idea about an inherently unpredictable future. And other people could be right too. And certainly I can be wrong, as the experience would tell.
All right. Well, Dan, thank you so much for joining us today. Looking forward to having you back. I know you have a book coming out in 2025, and we will certainly have you back on to discuss that when the time comes.
Great. Well, thank you, Max. I appreciate it.